Well, good evening and welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Now, tonight we're going to do a video comparing managed funds and listed investment companies. Now, these two are investment vehicles, but they have some key similarities and differences that we're going to discuss. If you're thinking about investing in either of these vehicles, make sure you watch the whole of this video because I go through a lot of important information, and at the end I will tell you which of these two I prefer. So make sure you stick around. If you haven't already, you may want to consider subscribing. We do videos on personal finance and investing. And if you find this video useful, make sure you leave a like on it before you go. It really helps my channel out. Alright, so let's get into it. So managed funds and listed investment companies are two forms of investment vehicles that you might want to consider as part of your investing strategy. Now, many professional investors don't really like using vehicles like this because they prefer to pick their own shares and choose their own stocks to invest in. But anyone who's a beginner or who doesn't really find any appeal in picking their own shares, or you might find it a little scary, these two vehicles might be a good option to look at. Because although there are many bad funds and LICs out there, there are also many good ones to look at. And even a lot of seasoned investors use managed funds and listed investment companies in investing. So I have done videos on these two types of vehicles before, just explaining what they are. So if you're really interested in finding out more, make sure you check them out. So without further ado, let's get into it. So let's go through the similarities first. So as I said before, both are investment vehicles, but both are what we call active investment vehicles. So that means with an LIC and a managed fund, both of these things will usually have what's called a fund manager in charge. Now, this is the person who is paid to pick stocks for the fund or company. So because there is a fund manager and a team of people behind the fund manager, always looking at the market, always picking stocks, always choosing stocks that they think will do better than others, you have to pay higher fees for these services because unlike an ETF or exchange traded fund, which just follows a set of rules, it's basically run by a computer that just picks the stocks in an index. A managed fund is actually a person, a highly paid person or team of people who actively choose shares on your behalf. Now, whether they choose the right shares is a measure of performance. So when you look at either a managed fund or a listed investment company, I encourage everyone to look at the performance of the fund or company to work out whether it's a good investment or not. You can look at the performances over the last year, over the last 3 years, over the last 5 years, over the last 10 years sometimes, and see how those funds or companies have performed against the market or against a benchmark. So that's also something to keep in mind. Managed funds or LICs will normally charge a higher fee compared to an ETF option because you're paying for that expertise, that management. But that's pretty much where the similarities end. So let's have a look at the differences. So the first difference here is actually the structure of the vehicle that I was talking about. So a listed investment company is, as the name suggests, a company. It is a company that buys other companies. And when you buy shares in the listed investment company, you are buying a piece of ownership in that company, just as you would buying shares in Apple or Facebook or BHP Billiton or any of those companies. So that's the first thing to keep in mind. A LIC is a company, whereas a managed fund is a trust. So a trust works a bit differently to a company. You don't buy shares in a trust, you buy what's called units. And a unit still represents a share of the profits or losses that a trust might carry with it. Just as a side note, an ETF is also a trust structure, but it is traded on the stock exchange. Most managed funds aren't traded on the stock exchange. And that brings me to my second point. With a managed fund, you have to apply to buy units in a typical managed fund. Whereas an LIC, you buy shares of them on the stock exchange, so on the ASX or the NYSE or any other stock exchange. So with an LIC, you buy shares in it, and like any other share, you can buy between 10 and 4, Monday to Friday. That's the trading hours, and that's when you can buy shares in the LIC. With a managed fund, it works very differently. So with a managed fund, you actually have to apply with the fund manager to purchase units in the fund. Now, this isn't done on the exchange. It's done as a sort of private transaction. So what happens is you fill out a big form and you'll send it off to the fund manager. And on the form, it'll say how many units you want to buy with how much money. The fund manager will actually issue you units after the trading day has finished. So the fund's unit price will actually be set at the end of each trading day, and then you will be issued shares based on that price. You can't actually pick the time of the day based on what the price movement is doing to buy in. You have to sort of accept the price that the fund manager gives you at the end of the day. You'll be issued with units, just like with shares, you'll be issued with units in the fund, and then you will own a share of the trust's profits. And that brings me to my next difference, price and net tangible assets, or NTA. So a managed fund will always trade at its net tangible assets. So put simply, that's the value of all the companies and assets that that managed fund will own, divided by how many units there are in the fund. So it might be $2, $2.20. This is worked out once per day, and it's literally the price of the unit that you will buy if you apply for the managed fund. Now an LIC, because it trades on the stock exchange, its price can actually be determined by other factors such as greed, such as fear, such as the love of the LIC in question, because popular LICs often trade above their net tangible assets, whereas LICs that might not be doing so well often trade below their net tangible assets. So even though a particular LIC might have a net tangible asset of, say, $5 million, the shares might be trading for a value of $4 million, so a 20% discount. You don't really get that with a managed fund. Now this can provide opportunities because obviously if you're buying $5 million worth of assets for $4 million, it's an instant return. Conversely, if you're paying $6 million for $5 million worth of assets, you're actually paying a premium. Now whether that premium is worth it is something else to consider. Another difference between LICs and managed funds is how the structures treat dividends. So if you don't know, a dividend is a payment that's paid out by the company, and it's basically paid to the owners of the company or the shareholders. So a lot of people love dividends. In fact, everyone loves dividends because it's passive income. You literally just get paid for owning something. There are not many things you can buy that will actually pay you for owning them, a house being maybe the other example. But because a listed investment company is a company that owns other companies, the other companies pay their dividends to the listed investment company. And then the listed investment company can choose when they pay them to the shareholders. So often a lot of listed investment companies will stockpile dividends when times are really good, and so they can continue to pay out the dividends when times maybe aren't so good and the economies might be going through some struggles. Because a managed fund is not a company, it can't really do this. So laws around trusts mean that managed funds have to pay out all dividends that they receive to their unit holders every year. So if you own units in a managed fund, every year you will get a statement saying how many dividends were paid. And these are normally not even called dividends, they're called distributions because they come from a trust. So if the managed fund makes a capital gain in a year, it can pass it out to the unit holders, whereas a listed investment company can keep it within the company for tax affairs. But that's a very complicated matter, but it's just another key difference. Managed funds can't stockpile dividends the way that listed investment companies can. And that's something to keep in mind if you're an income investor. And the final difference we have here is open and closed. So a managed fund is what's called an open investment. So this means that when people want to buy into a managed fund, they give their money to the fund and the fund increases its size in proportion. And in the same way, if someone wants to sell their units in the fund has to pay them out, drawing money away from the fund. Now with an LIC, once the LIC is on the stock exchange, it's what we call a closed fund. So when you buy shares in the LIC, you're not buying them from the company. You are buying them from other investors who want to sell them. So in that way, the pool of assets and money that the listed investment company is managing doesn't increase based on how many people are buying and selling. The listed investment company can choose to sell its own shares and increase the pile of money in the company to then buy more shares. But if people sell shares in the listed investment company, the company doesn't have to pay them out. But a managed fund does because it's a trust. All right, so that brings me to my personal preference, and it is listed investment companies. And it's all because of this reason, open and closed. So normally what happens if there's a stock market crash is that people get really spooked and they want to pull all their money out of the market so they don't lose even more. So with a listed investment company, this can actually be a good thing because if something like that happens, it will normally pull its price far below its net tangible assets or its actual value. So that means that if you want to buy shares, you can do so at a heavy discount. But with a managed fund, if investors are selling their units in it, the fund actually has to sell the shares that they already own to pay out these investors, which actually lowers the return because the fund is selling shares in a time where shares are already collapsing. Whereas a listed investment company doesn't have that problem. So that is why managed funds are not my personal preference and listed investment companies are. It's all about this open and closed investment vehicle. Okay guys, thanks so much for watching. If you liked this video or found it useful, make sure you leave a like on it. And if you're interested in finding more information on either LICs or managed funds, make sure you check out the videos that I have on both that go into more detail on each one. Thanks so much for watching. I hope you enjoyed the video. I'll be back with some more videos soon, but for now, good night.